Okay guys, welcome to our channel. Have you ever wondered exactly how the global financial environment will affect Bitcoin and other cryptos? We're going to be talking about that today. We're going to be focusing a little bit more towards inflation and how interest rate increasing can negatively affect risk assets. So we're going to be talking about what is a risk asset. We're going to be talking about how these assets traditionally act during times of economic downturn. We'll briefly cover interest rates. We're definitely going to be talking about where we think Bitcoin and cryptocurrency will go from here. And if we do enter a more severe recession and interest rates continue to hike, how cryptocurrency will react. We're going to be talking about how you can prepare, and we're going to be giving our closing thoughts and our opinions. Before we get into any of this, if you want to stick around to the end of the video to find out all of this, make sure hit that like, comment, and subscribe button down below. If you want to follow us on Twitter and Telegram, the links are in the description. First and foremost, let's dive right into the chart you see in front of us, and we're going to be taking a look at that short-term price prediction for Bitcoin before we get into the rest of the video. So we can see Bitcoin has been trading in an ascending channel formation, and this is our ascending channel formation here. We have currently seen a pretty significant move from Bitcoin pushing above that local resistance, that ascending trend line of the ascending channel. We pushed up and got rejected on the top channel over here, our second data point for our ascending channel. This happened to line up with $48,000, which was a 200-day moving average on the day at the time, rejecting, breaking the bull market support band, falling back down, and finding support on these previous highs. So these previous highs, which I circled over here, we can see we found support on this bottom point, which is about 44,400. Since then, we have pushed back up, retesting the ascending resistance and rejecting. This is a very significant move, this rejection. It's indicating that we don't have the strength to push back over, and there's a very high chance we continue downwards. Right now, we are kind of in between a strong support and a strong resistance. The strong resistance being this ascending channel, and the strong support being this gray box. Depending on the direction we take will determine the continuation. Therefore, if we drop below this box here, we can assume and we can predict with a high degree of certainty that we will end up down below at $41,000 or $40,000 again. Vice versa, if we push upwards, retest and reclaim this trend line, break over 48K, that will be our macro trend flipping to bullish, and we can assume that we have completely flipped that downtrend and we are pushing to 52K. All right, guys. Keep an eye on the chart. Don't make any decisions now. I would advise away from trading right now. I would be waiting for a move. Either we break above here and then you say, yes, okay, time to re-enter, or we lose this level here. And then of course, you're looking at selling, exiting, or whatever, shorting, or just looking for lower levels. All right, with that being said, let's dive right into the video, and we'll be discussing the topic we talked about at the start. So what type of asset class is cryptocurrency? Well, cryptocurrency, just like equities, commodities, bond yields, specifically high yield bonds, real estate, stocks, and other currencies, cryptocurrency is a risk asset. All right. What does a risk asset mean? Well, it means that it has a high degree, or should I say significant degree, of price volatility. That is what a risk asset is defined as. And we can agree with that because Bitcoin is a very volatile asset. If you look at the growth of Bitcoin, although it has been a significant growth since inception, we have seen significant drops during this period. And we've seen these drops much more frequent than we would see in a traditional market, guys. All right. So it is a volatile asset. The day-to-day trading of Bitcoin is not as volatile as many would expect. Sometimes we see 1% range. Sometimes we don't even see a percent range. But the overall arching narrative of Bitcoin, it is a quite volatile asset. Still, it is still quite young. It's only just readily being adopted. There's still a long way to go before it stabilizes and reaches its true value. So moving on from there, guys, I want to talk about why risk assets. I'm going to go on a bit of a tangent. Why risk assets are generally the assets to get wrecked when interest rates rise. And that's the narrative of today's video. We're talking about how interest rates are going to affect Bitcoin. We know Bitcoin is a risk asset. We're going to be talking about interest rates now. So moving back and talking about interest rates, one of the dangers historically of low interest rates, should we start with, is that they can significantly increase asset prices. And they do this because you have an environment where you have companies and individuals and retailers being able to take loans at a very small interest rate and therefore taking on debt at low interest rates. Companies love to take debt on and then use that debt to accumulate assets. All right, so you have these massive companies and real estates and institutions taking on a lot of low interest debt and buying up a lot of assets. And that's why we've seen the housing market boom. That's why we've seen stocks boom. That's why we saw cryptocurrency boom. All of these asset classes have massively risen since those interest rates massively dropped in March 2020 from the bottom of the COVID crash. And we've seen huge pushes in SPS 500, NASDAQ, you look at traditional stocks, Amazon, Facebook, Twitter, Tesla, all these other stocks absolutely booming. Look at Bitcoin and other traditional cryptocurrencies. Altcoins popped, housing market exploded. So we've seen a huge increase in these asset classes. On the flip side of the coin, guys, when interest rates rise, traditionally these asset classes fall. Right? It's completely the opposite. So now you have an environment where the debt costs more interest. So the debt that these companies, these individuals, these people have accumulated, they're now paying a greater interest on that debt. All right, and we'll be talking a little bit about that in just a moment, of how exactly that really relates to the prices of assets falling. So there's two reasons why. I would like to break it down. Two reasons. There's two reasons why, and this isn't necessarily specific towards cryptocurrency. This is more generally talking about risk assets, but it does constitute cryptocurrency. You have two reasons why asset prices fall, specifically risk assets fall during interest rates rising. The first one is the risk-free rate becomes more attractive. So the return on your investment, specifically return on a risk investment, becomes less favorable if there are safer rates of return. So I'm gonna just describe an example, because it's kind of hard to show you on a chart. So I'm gonna try just listen to what we say over here on a chart example. So this is an example. So imagine that you have a 10-year treasury bond that offers 2.4% pre-tax yield. All right. You're looking at a stock that sells for $100 per share, and that has diluted earnings per share of $4. Of that $4, $2 is paid out as a cash dividend. The result is in earnings yield of 4.4% and a dividend yield of 2%. All right, so not bad. Now, this is kind of a scenario we're facing right now. All right, now imagine that the Federal Reserve increases interest rates higher, which they are currently doing. That 10-year treasury ends up yielding 5% pre-tax. All else equal, why would you buy a stock that has a lower return? All right. The only motivation to buy the stock instead of treasuries under this scenario would be if the price of the stock were to drop in value. All right. So it's saying in this example, it's more of a real world scenario example of what we just said before. During these periods of increasing interest rates, these risk assets fall. Why would people be inclined to buy falling asset prices when they can keep their money on the sidelines that is more safe and enter when they've dropped? So it also plays onto a little bit of market psychology there. I'm not going to go into that too much today, but it's very common to see this when crashes happen. They happen quickly, they happen rapidly, and they drop very hard. All right, so another reason why I would say these asset prices fall, and this is the big one, this is the one we're really going to be focusing on, is the cost of capital rises. And we're going to be talking about the DXY a little bit here, and we can see this is a visual representation of the strength of the US dollar compared to other asset classes. We've been in a 20-year, I think 21-year symmetrical triangle consolidation pattern. And it's pretty much inverted. So every single time we have these drops in US dollar strength, we generally have increases in asset price. All right, they generally increase. And we can look back at other charts to correlate this, but it's generally the truth. This time around, we're seeing the DXY break out of this trend, which is signifying a new uptrend is about to begin. It is indicating money is coming out of traditional assets, so risk assets, and moving into US dollars, which further supports the statement we just said before. People are taking money out of these risk assets, they're dropping in value and putting it in safer places of guaranteed return. All right. So cost of capital rises is the second one. All right. So another reason, I'm just going to elaborate on this a little bit, is basically when interest rates rise, this puts businesses and real estate into more tricky positions, and it can basically have huge influences on the level of net income reported by those companies on their income statements. So when you have when a business borrows money, it does it through either a bank, of course, or a loan, or it buys issuing corporate bonds. If the interest rates of a company can get in the market are substantially higher than the interest rates it is paying on its existing debt, it will have to give up more cash flow for every dollar of its liabilities outstanding when it comes time to refinance. So this basically results, or should I say, the result of this is much higher interest expenses, which causes earnings to decline, which in turn causes the stock price to decline. So we can take this and we can use a formula. I think it's called, top of my head, I've done this years ago, I think it's interest covering ratio. And basically what that tells us is, it tells us a lower interest covering ratio makes a company appear more risky and less healthy, as it has less available cash to cover its interest. I know I've gone on a massive tangent here, but this is very relevant to cryptocurrency because so many institutional investors and so much institutional money that is borrowed on debt is now in the cryptocurrency market. You think these guys like Michael Saylor and stuff are buying these assets without debt? You're freaking mistaken. They're using debt, a lot of debt, to accumulate these assets. And the problem is, as these assets start to, should I say, as these interest rates start to fall, their interest coverage ratio massively starts to fall. All right, that has profound effects on basically how long they're able to hold this asset. They're paying higher interest rates back. So generally, what you see here, you see people withdrawing money from these high risk assets. You'll see cryptocurrencies start to fall in price as people need to liquidate. All right, they need to liquidate their risk assets or their high risk assets from their balance sheet to increase their net cash flow, to cover their bad debts or cover their increased interest expenses, to keep their company looking healthy and meeting net profit targets. All right, and that is exactly why we've seen these traditional stocks, these massive stocks, Facebook, PayPal, all this kind of stuff tank. We're seeing these companies tank. Look at this. Look at this PayPal. All right, guys, it went from $302 a share all the way down to 70, all the way down to 94, 30% drop. All right, it looks like an absolute rug pull, guys. It literally looks like a rug pull. Look at Amazon. All right, ascending channel, breakdown, retest. What do you think is going to happen next? All right, guys. So they're not looking good. It's not looking healthy. And I guess we've talked a little bit about the DXY and how the DXY is just a visual representation of everything we've just said before. And we've talked about cryptocurrency. We've talked about how these, I guess, behind the scene actions, which you probably aren't too aware of, will affect cryptocurrency. At the end of the day, cryptocurrency is a risk asset. It will follow the same path. So moving on from that, let's talk about retail, because we've talked a lot about institutions. We've talked about how institutional money will affect the market. Increasing interest rates, and we talked about that, how that affects the cost of products and the cost of living, and how interest rates have been wrongfully or inaccurately reported, but your cost of living starts increasing, right? So interest rates rise, cost of goods increase, cost of living increases, average household savings will decrease, average household money they're able to spend, I'm not too sure what the terminology is, I can't remember, available expenditure, decreases. Right? When people have less available expenditure, they take less risk, they buy less risk assets, they liquidate assets that have high interest rates. So it's all supply and demand. You look at increasing interest rates, you can take a look at the housing market, for example. The housing market is going to fall. A lot of people are saying a housing market won't fall, blah, 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 blah. You have, let's take a look at this real quickly. Individual debt, where can we find total personal debt? All right, I don't even know what that number is. It is massive. Per debt, per capita, $68,000, per holding, $6,000. Can we find an average debt somewhere around here? Debt per citizen. Anyway, we got basically heaps of debt. What I'm trying to get with this point is, as interest rates rise, people with debt, mortgages, all right, for a prime example, it starts to increase, all right? They have to pay back more interest. Sometimes they can't afford these interest repayments and they have to foreclose their asset. They have to liquidate those assets to repay the interest on the loan. What does that do? What does it do? It drives up supply. All right. The issue is with increasing interest, there is less demand. People are not willing to buy this supply anymore. All right. So you have a situation where there is more supply, but no one's buying it. So the prices fall. All right. And this is common to see in housing markets. This is very common in stocks. And like we talked about before, this is what we're seeing. And interest when it comes to cryptocurrency, kind of what we're seeing as well. All right, guys, so taking a look at Bitcoin, what do I think is going to happen? If interest rates continue to rise at this rate of 0.25% or even 0.5%, of course, that's going to have profound effects on risk assets. It's going to have profound effects on available spending for retail. It's going to have profound effects on how institutional investors are able to manage their positions. Will they have to pull out their positions? Most likely will have to mostly liquidate a lot of their positions. So guys, I think if we're going further into this, if interest rates continue to rise for cryptocurrency, be aware, be prepared to see further drops downwards. And we're not going to go into bearish predictions here, but we've talked a lot about this on our channel that, you know, this ascending channel, if we don't get above $48,000, it is just going to end up being a huge bear flag. And we're going to be heading all the way down. Our target is 22,000 to 24,000. And we've been saying this since all the way up here. We told you guys we were going to 35K at 60K. It happened. All right, happened. Now we're telling you guys, if we don't get above 48K and we don't close a strong candle above 48K and push higher, we're in trouble. I would go out to say 54K. If we don't even get above that on this next move, it does push up, we're in trouble. Bitcoin is not looking good. Cryptocurrency is not looking good. And a lot of people are going to say otherwise, but the global economic environment is the best predictor for risk asset performance. All right, I'm going to say it again. The global economic environment is the best predictor for risk asset performance according to the history of Bitcoin, according to the history of risk assets, according to historical data. Bitcoin has never seen a proper recession. Keep that in mind. We saw the 2020 COVID crash, black swan event. We have never seen a proper recession for Bitcoin. It is very hard to predict how Bitcoin will perform, but we can assume that it's going to perform as an equal to other risk assets, and we can attribute the, match what our expectations are for those with that of Bitcoin. Okay, guys. I hope you enjoyed the video. There was a lot to cover. I really tried my best to condense it into a simplified format. There is so much more I can go over, but I wanted to kind of focus on interest rates today and how interest rates affect retail. More importantly, how it affects institutions, how that changes your cost of living, how that impacts your available cash flow and expenditure, and how that can relate to Bitcoin's price in the future. If you have any questions, leave them down below. Of course, tricky video to do. I didn't really prepare for this video. I kind of just winged it. So I hope I kind of got everything out there. And of course, remember to like, comment, and subscribe, and we'll catch you in the next video.